Okay, so let's continue now with something more complicated, which is equity transactions. I'm gonna explain them while doing the exercises. That's most of the time the easiest way to understand these things. So let's start with issuing 1,000 shares at a par value of $1. So we're gonna receive $1,000 from our shareholders. They're gonna pay this money to us, and we are gonna receive that money into our capital. Okay, so 1,000 shares at $1 is 1,000 total outstanding shares. We don't have any treasury shares yet. Those are shares of the company that the company itself buys. So our total of issued shares is thousands, which appears here. So it's debit cash, we're receiving cash against credit capital. Now we're gonna buy back 100 of those shares. How much are we gonna pay for them? So we're gonna buy 100. We're gonna pay $2 for them. Because let's suppose they've gotten more expensive. So I'm gonna update this right here. First, as you see, capital remains unchanged because you measure capital always at par value. Okay, we'll see what happens with the 200. So we paid for it. We paid for the shares, 100 shares at $2 each. So that's cash going out. Oh, what's happening? Cash going out. And now the question is, where are we gonna show those shares? Normally, if you buy shares, you show them as an asset, right? But because this is a transaction with equity owners, that's why we have to show them as an equity. So instead of doing 200 debit as an asset, we're doing 200 debit as equity. This makes sense. We just received 1,000 from our shareholders, so equity goes up. Now we're giving 200 back to our shareholders, so equity goes down. And so what appears here in the treasury shares is the fair value of the shares we bought. So whatever we paid for those shares is what is gonna appear in the equity in the account of treasury shares. If we're gonna give them back to the public, which is gonna happen in the next exercise, we have to keep in mind always the historical price we paid for those shares. So we're always gonna keep in mind the $2 we paid for them in order to move down this balance of 200. What's happening next? Our employees have some options. They're gonna exercise them for $3, right? So we're gonna receive 150 from our employees. They're paying us 3 times or 50 times $3. What are we giving them in return? We're giving them in return 50 shares. So our amount decreases by 50. And originally here we had 200, but this goes down by 100 because we're giving them 50 shares of $2 each. So we're still missing 50. We received 50 in cash. We're giving them 100 of treasury shares. The excess that they paid for those shares is going to be recognized in additional paid-in capital, right? So this is also called sometimes share premium. There's and it has some other words too, but it's all the same. It's the amount that shareholders pay in excess of the par value, or in this case in excess of what the treasury shares were worth in your accounting. This was the hardest part. Let's continue with the easiest part. Now we're gonna close the P&L because, as you can tell, our balance is unbalanced. Here we have a net profit of 3,000, so the credit balance is 3,000. We're gonna counter that with the same amount but in debit. Right? I'm writing this in red because you won't see this in the actual financial statements. This is just an accounting transaction. Okay, on the financial statement it doesn't appear. So we do debit P&L and credit retained earnings. Okay, this can be just in black. So those 3,000, just gonna write it, are gonna increase my retained earnings. So whatever happens in your P&L at the end of the year accumulates in retained earnings. If you have profit, retained earnings goes up. If you had loss, it goes down. So it would affect the debit. Now we see here other comprehensive income. What on earth is this? This is actually just a second income statement. It's a special income statement. I'm not gonna spend too much time explaining it, but the important thing to know is that very specific limited transactions are being recorded in other comprehensive income. Apart from that, it's exactly the same as the normal income statement. That's why we're going to close it the same way. So we have a net balance of 200, which is a debit balance. So I'm going to counter that with a 200 credit movement, like this. And I'm also going to accumulate it in equity. So we did a credit here. We're going to do a debit here. Okay. That's it. Now let's declare some dividends. So declaring dividends means taking out money from your retained earnings, right? And if you're paying them, it affects cash. In this case, we're not paying them yet, so we have a liability with our shareholders. So it's debit retained earnings. This is decreasing, and we have an account payable that appears. Oh my god. Okay, now let's end with a special kind of dividend. Instead of paying money to our shareholders, we're gonna give them more shares. So in this case, we're saying for every share you have, I'm gonna give you an additional share. Okay, so we have 1,000 shares in total, and we're gonna add 50% to it. Okay, actually I didn't show here that we moved 50 treasury shares to 50 outstanding shares. So as you can see, I increased the number with 50%. Here, I'm gonna give it a color, and this adds up to this. And since this is linked with the total value, it's automatically increased. So don't mind this. What happened is capital went up, right? By how much? By 500. And just as in normal dividend payments, this comes from retained earnings. Okay, so we're taking 500 out of retained earnings and sending it to capital. That's what happened here. As you can see, we don't, in the capital, we only mind the par value. Our treasury shares remain unchanged. I hope this clarified a little bit about equity transactions.